Audit evidence forms the foundation of the auditor's opinion and is essential for obtaining reasonable assurance that the financial statements are free from material misstatement. ISA 500 Audit evidence defines audit evidence as the information used by the auditor in arriving at the conclusions on which the audit opinion is based. Evidence is obtained from accounting records, supporting documentation, external confirmations, analytical procedures, inquiries, observations, and other audit procedures performed throughout the engagement. The sufficiency and appropriateness of audit evidence directly influence audit quality and determine whether the auditor can express an unmodified opinion. A risk-based audit approach requires evidence to be gathered systematically and evaluated critically using professional judgment and professional skepticism, particularly in areas involving significant estimates, management judgment, or fraud risk. The preparation of financial statements involves a series of management assertions, which are implicit or explicit representations regarding the recognition, measurement, presentation, and disclosure of financial information. Auditors design audit procedures to test these assertions and obtain evidence supporting their validity. For classes of transactions and events and related disclosures, the principal assertions include occurrence, ensuring that recorded transactions actually took place and relate to the entity; completeness, confirming that all transactions requiring recording have been included; accuracy, ensuring transactions have been recorded at appropriate amounts; cutoff, verifying that transactions are recorded in the correct accounting period; and classification, ensuring transactions are recorded in the appropriate accounts and presented correctly within the financial statements. Testing these assertions enables auditors to evaluate whether reported financial performance has been fairly presented. For account balances and related disclosures at the reporting date, auditors evaluate a different set of assertions. The existence assertion confirms that recorded assets, liabilities, and equity balances actually exist at the reporting date. Rights and obligations verify that the entity owns recorded assets and is legally responsible for reported liabilities. Completeness ensures that all balances requiring recognition have been included in the financial statements. The valuation and allocation assertion assesses whether assets and liabilities have been measured appropriately in accordance with the applicable financial reporting framework, including impairment, depreciation, provisions, and fair value adjustments where relevant. In addition, presentation and disclosure assertions require that financial information is properly classified, understandable, accurately described, and adequately disclosed in accordance with accounting standards. Collectively, these assertions provide the framework upon which substantive audit procedures are designed and performed. Auditors obtain evidence through a variety of procedures specified by international standards on auditing. Inspection involves examining physical assets or documentary records such as invoices, contracts, title deeds, or accounting records to verify existence, ownership, or transaction occurrence. Observation consists of watching procedures being performed by others, such as inventory counts or control activities, to assess whether prescribed procedures operate effectively. External confirmation provides highly reliable evidence through direct communication with independent third parties, including bank confirmations, receivable confirmations, legal confirmations, or supplier balances. External evidence is generally considered more persuasive than internally generated evidence because it originates outside the entity and is less susceptible to management manipulation. Additional audit procedures include recalculation, reperformance, analytical procedures, and inquiry. Recalculation involves independently verifying mathematical accuracy by recalculating depreciation, interest, payroll, inventory valuations, or tax computations. Reperformance requires the auditor to independently execute internal control procedures or accounting processes to confirm their effectiveness. Analytical procedures involve evaluating financial and non-financial information by identifying plausible relationships, trends, ratios, or unexpected fluctuations that may indicate material misstatement. Inquiry consists of obtaining explanations from management, employees, legal advisors, or other knowledgeable individuals regarding transactions or business events. Although inquiry provides useful information, responses alone rarely constitute sufficient audit evidence and normally require corroboration through other procedures. The quantity and quality of audit evidence are equally important in supporting audit conclusions. The quantity or sufficiency of evidence refers to the amount of evidence obtained and is influenced primarily by audit risk and materiality. Higher assessed risks of material misstatement generally require larger sample sizes and more extensive audit procedures. However, obtaining large volumes of weak evidence cannot compensate for poor evidence quality. The quality or appropriateness of audit evidence relates to its relevance and reliability in supporting the auditor's conclusions. Auditors therefore seek evidence that is both sufficient in quantity and appropriate in quality to reduce audit risk to an acceptably low level and support the audit opinion expressed. The relevance of audit evidence refers to its logical connection with the assertion being tested and the audit objective being achieved. Evidence is relevant only if it directly addresses the particular financial statement assertion under examination. For example, inspection of title deeds provides relevant evidence regarding ownership of property, while receivable confirmations provide relevant evidence concerning existence and rights over trade receivables. Audit procedures should therefore be specifically designed to address identified risks and the relevant assertions associated with each financial statement balance or transaction class. Evidence that does not address the audit objective contributes little to the overall audit conclusion, regardless of its quantity. The reliability of audit evidence depends upon its source, nature, and the circumstances under which it is obtained. Evidence obtained directly by the auditor is generally more reliable than evidence obtained indirectly through management representations. External evidence received independently from third parties is normally more persuasive than internally generated documentation, while documentary evidence is generally more reliable than oral explanations. Original documents possess greater reliability than photocopies or electronic reproductions where authenticity is uncertain. Reliable evidence is also enhanced by effective internal controls supporting its preparation. Auditors evaluate both the relevance and reliability of available evidence before determining whether additional procedures are necessary. Ultimately, high-quality audit evidence is fundamental to professional auditing because it provides the basis for independent conclusions regarding the fairness of financial statements. By systematically testing management assertions using appropriate audit procedures and critically evaluating the sufficiency, relevance, and reliability of evidence obtained, auditors are able to form well-supported opinions that enhance transparency, accountability, and stakeholder confidence in financial reporting. Understanding assertions and audit evidence is therefore central to the successful application of international standards on auditing and the effective performance of risk-based external audits.